Okay, let's unpack this. Picture a nation, the UK, at war for over half of 100-year stretch, constantly fighting.
Yeah, it's kind of mind-boggling when you think about it.
And here's the really astonishing part. Unlike all its enemies, Britain never actually ran out of money. It never had a financial crisis during all that time.
That's the core question, isn't it?
Uh,
How on earth did they manage that?
exactly. How did a country seemingly always at war stay so financially strong when its rivals couldn't? That's the puzzle we're really digging into today.
Right. And for you, our listener, if you're keen on understanding the deep roots of financial power, this story is, well, it's fundamental.
So we're tracing this back to a specific moment.
We are. Back to the creation of the world's very first central bank, the Bank of England. We're aiming to pull out the surprising facts and give you those clear explanations you look for in these deep dives.
Okay. And our sources, they really highlight this connection between war, government debt, and this, well, revolutionary idea of a central bank.
Definitely. Because before the Bank of England, the British monarchy's track record with money was, let's just say, not great.
Not great is putting it mildly.
Yeah.
You had King James basically cornering the pepper market with the East India Company for his own benefit.
Rigging the market, essentially.
And then King Charles I, even more dramatic, just seizing gold and silver that merchants had deposited for safekeeping, just took it.
Imagine. And that history, that lack of trust, it had real consequences.
Made borrowing incredibly difficult, I assume.
Extremely. Think about it. The government was apparently offering interest rates as high as 30% a year and still struggling to find people willing to lend them money.
30%! Wow, that shows you how little faith people had.
Precisely. So that deep-seated mistrust was a massive problem, especially with wars needing constant funding.
Okay, so our mission for this deep dive is clear. Figure out how the Bank of England solved this borrowing crisis for the government.
And understand its huge impact on Britain's rise as a global power. Then later, we'll draw some interesting comparisons with China's banking system today.
That's good. So the immediate problem was they just couldn't borrow.
Pretty much. They were locked in these expensive wars with France, and the usual channels for loans had dried up. They desperately needed reliable funding. That was the spark.
And along comes William Patterson, a London merchant.
Right, with a pretty clever idea. He saw the problem. Individual merchants were terrified the king would just default, like previous monarchs had.
I don't blame him.
So Patterson proposed pooling their resources, creating a joint stock bank.
Safety in numbers.
Exactly. It spread the risk. No single merchant would be wiped out if the worst happened. And crucially, this appealed to those wealthy London merchants who had, very legitimate fears about royal IOUs.
So it directly tackled that trust issue.
It did. Lending collectively felt safer than lending individually to an unreliable monarch. But the merchant support wasn't the only piece of the puzzle.
Parliament had to get involved too.
Absolutely critical. Parliament provided the legal muscle. They passed a law in 1694 that officially established the Bank of England.
So it's a three-way thing. Merchants with the cash, the king needing the cash, and Parliament making it official and legal.
A powerful combination.
Yeah.
It gave the whole thing stability and legitimacy.
And how did they actually get the money together initially?
Through selling shares, they aimed to raise £1.2 million, which was a huge sum back then.
And did people buy in?
Amazingly, yes. London merchants subscribed the entire amount in just 12 days.
12 days? That's incredible. Shows how much appetite there was for a safer way to deal with government finance.
It really does. And here's the key. That entire £1.2 million was immediately lent to the government.
The whole lot?
A whole lot, as a long-term loan.
Yeah.
And the interest rate was only 8% per year.
Only 8%. Compared to the 30% they couldn't even get takers for earlier, the government must have been thrilled.
Very satisfied. And crucially, the loan was secured. Specific government tax revenues were legally earmarked to guarantee repayment to the bank.
So the bank had a guarantee. That makes sense. It wasn't just based on the king's promise anymore.
Exactly. That legal guarantee, backed by Parliament and specific taxes, was vital.
So the government got its cheap loan. What did the Bank of England get out of it besides the 8% interest?
Well, this is where it gets really interesting. Parliament granted the bank some very significant privileges in return. The big one was the exclusive right to issue banknotes.
Banknotes, like printing money.
Essentially, yes. Paper money backed by the bank's credibility and ultimately the government's promise to repay the bank. And just like that, the world's first central bank was born.
That power to issue banknotes must have been huge.
It was transformative. It gave the bank influence over the money supply, laying the groundwork for what we now call monetary policy, even if they didn't think of it in those exact terms back then.
So you might ask, okay, was this just another bank lending to the government? How was it different from, say, merchant banks already around?
That's a really important distinction. Yes, there were other banks, but they mostly served private merchants, market customers.
Right.
The Bank of England was unique because the government was its primary customer. That was its whole reason for being initially.
And that direct link, legally secured between the government's finances and private capital, that was the real game changer.
That was the fundamental innovation.
It also explains something people sometimes get confused about. Why were early central banks, like the Bank of England, privately owned?
Right. Our sources point this out clearly. The government needed to borrow from private individuals and institutions. You need two separate parties to have a meaningful contract, the borrower and the lender.
You can't really have a contract with yourself.
Exactly. So having the bank as a legally distinct, initially private entity was necessary for that contractual relationship to work and build trust.
And this whole setup created a kind of positive feedback loop.
A virtuous cycle, yeah. It became an engine for Britain's growth. Reliable funding meant a stronger nation.
Which could then trade more, expand, generate more wealth.
Precisely. And more wealth meant more private capital available. Capital that became increasingly willing to lend back to the government via the Bank of England, because the government was now seen as a much safer bet.
So, stronger nation, more money available, which makes the nation even stronger.
It just kept reinforcing itself. And it wasn't just Brits lending anymore. Foreigners started seeing British government debt, facilitated by the bank, as a good investment.
Is there a specific example that really shows this in action?
The American War of Independence is a great one. Think about 1782. Britain is fighting not just the American colonies, but France, Spain, the Dutch Republic, a multi-front war.
Sounds expensive.
Hugely. Yet when the British government announced they needed to borrow £3 million by issuing bonds,
Did they struggle?
quite the opposite. The market response was overwhelming. People offered to subscribe a total of £5 million.
Wow. They wanted to lend more than the government was even asking for in the middle of a massive war.
Exactly. And apparently, an enemy politician at the time basically said, how can you beat a nation like this? They can just conjure money through this system. Their own countries were limited by whatever was in the state treasury. Once that was gone.
Game over.
Pretty much.
Yeah.
It shows that direct link between financial innovation and, well, geopolitical power.
But hang on, it wasn't just the bank, right? Creating a central bank isn't like finding a magic money tree.
No, absolutely not. It's not a panacea. The Bank of England's success wasn't in isolation. It was deeply tied into two other critical systems working alongside it.
Okay, what were they?
First, the political system. Specifically, Britain had a relatively mature parliamentary system by that time.
We mentioned Parliament passing the law to create the bank.
Yes, that was crucial for its establishment. But just as important, Parliament provided that ongoing legal guarantee.
The guarantee that the government wouldn't just tear up the agreement.
Exactly. People trusted Parliament, perhaps more than they trusted the king alone, to ensure debts were honored. That formal backing built essential public confidence.
Okay, so the political system provided the trust framework. What was the second system?
The national fiscal system, the tax system.
Ah, right. We did a whole deep dive on British tax reforms previously.
And those reforms were vital here too. They ensured the government had a relatively steady, predictable income stream year after year.
Which made lending to them less risky.
Precisely. It underpinned the government's creditworthiness. If lenders knew there was a reliable flow of tax money specifically earmarked for repaying debt, they felt much more comfortable lending in the first place.
So it was really a three-legged stool: the innovative bank, the parliamentary guarantees, and the solid tax system.
That's a great way to put it. All three working together. That's what really powered the bank's success and Britain's financial strength.
Okay, that's a fascinating story about how the first central bank came about and why it was so effective. Now, you mentioned drawing some comparisons, shifting focus completely.
Yeah, let's pivot. We've seen how history and specific institutions shaped Britain's financial power. Now, to get a broader perspective, let's jump across the globe and look at a very different system: contemporary banking in China.
China's banking system.
Okay.
I mean, people probably know the big names, ICBC, Bank of China.
Right, you hear the names. But the system itself is incredibly complex. We're talking over 4,000 banks in total.
4,000.
Yeah. So do you really know the difference between, say, ICBC and maybe China Merchants Bank? Which one is better if you need a credit card versus a loan for a small business?
Good point. It's probably not as simple as just picking the biggest name.
Definitely not. So to make sense of it, we can roughly group Chinese banks into three main categories.
Okay, what are they?
First, you have the giants, the state-owned commercial banks. Then the joint stock banks, which have more varied ownership. And finally, the city commercial banks, which are much more local.
Got it. State-owned, joint stock, city commercial. Let's start with the big ones, the state-owned banks.
These are the ones most people recognize. ICBC, Agricultural Bank of China, ABC, Bank of China, BOC, China Construction Bank, CCB, and the Bank of Communications, BOCOM, is often included now. So the big five, sometimes big six.
And they are truly massive, right?
Dominant. They're state-controlled and together hold something like 40% of all financial assets in China. That state control obviously has huge implications for how money flows in the economy.
And their size comes from history.
Absolutely. Think about it.
Yeah.
From 1949 until the mid-1980s, these were basically the only banks in China.
Wow, for decades.
Yeah. So they built up these enormous branch networks. For older generations especially, that's just where you bank. There's a lot of inertia, established relationships. Plus, that implicit state backing makes them seem incredibly safe, which helps them attract huge amounts of deposits.
But seems safe doesn't always mean completely risk-free.
Well, exactly. There was a major financial fraud case back in 2014, the Pan Asia case. It involved wealth management products, sort of like investment funds, being sold through a Bank of China branch in Inner Mongolia. A lot of people lost money.
So even with the giants, you still need to be careful.
It's a reminder that due diligence is always wise. Yeah. Size isn't everything.
Okay, so that's the state-owned tier. What about the second group, the joint stock banks?
Right. This is the next level down. You've got names like China Merchants Bank, Shanghai Pudong Development Bank, SPDB, China Minsheng Bank, Industrial Bank Co. They're different because their ownership is more mixed. Often state entities hold shares, but so do private companies and individuals, more flexible.
And how do they compete with the big five?
Well, there's an interesting analogy used in our sources, comparing them to characters in that TV show Ode to Joy. Like they're talented, maybe internationally educated elites, but they lack the blue blood, the inherent state backing and deposit base of the big five.
Ah, so they have to try harder, be more innovative.
Exactly. They often need to differentiate themselves, find niches, offer better service, particularly to win deposits, which is always the lifeblood of a bank.
And have they succeeded in finding those niches?
Some definitely have. China Merchants Bank, for example, is widely seen as the leader in credit cards.
Really? Why is that?
They just seem to do it well. Easy applications. You can do it at branches, on WeChat, phone, online. And they have good offline services. Lots of partnerships with businesses offering discounts if you use their card.
I think you mentioned a KTV discount earlier.
Yeah, the Party World KTV discount was legendary. It really appealed to younger people. And apparently, it's often easier to get credit limit increases with them when you're starting out.
Okay, so CMB nailed the credit card market. Any others?
China Minsheng Bank is another good example. They really focused on lending to small and micro enterprises.
Businesses that the bigger banks might overlook.
Historically, yes. Minsheng Bank stepped into that gap and now serves more small and micro business customers than any other commercial bank in China. It's a huge market they tapped into.
So these joint stock banks, they seem more dynamic, maybe.
Often, yes. They tend to pay a lot of attention to their image. SPDB has that impressive headquarters on the Bund in Shanghai. They're generally seen as being innovative, attracting skilled staff with good salaries.
And for customers.
You might find better service, perhaps lower fees, maybe slightly better rates on wealth management products compared to the state giants. For personal banking, they're often a really strong choice.
Right, so state-owned joint stock. What's the third category?
The city commercial banks, or CCBs, think Bank of Shanghai, Bank of Beijing, Bank of Chongqing.
And where did they come from?
They mostly grew out of urban credit cooperatives that sprang up in the 1980s, mainly to funnel funds into local economic development. Then, in the mid-90s, with the commercial bank law, they were formalized to specifically serve local small and medium-sized businesses.
So very locally focused from the start.
Very. And they had this interesting dual management structure.
How so?
They're managed day to day by the local city government, but they're also supervised financially by the national banking regulator, the CBIRC.
So, pulled between local priorities and national rules.
Kind of. They're definitely important financial players for local governments,
Hmm.
especially in funding construction projects, often linked to land development, that whole land finance model in China.
But they're generally smaller than the other two types.
Yes, usually smaller in scale, financial strength, and overall capability compared to the state-owned and joint stock banks. The analogy used is like a well-known local TV news anchor.
Ah, influential in their city or region, but not really a national name.
Exactly. Very important locally, but less presence on the bigger stage.
Are they all pretty similar, these city commercial banks?
No, there's huge variation. There are over 100 of them. Some, like Bank of Shanghai or Bank of Beijing, are in major economic hubs and have become quite large and sophisticated, almost like joint stock banks in some ways.
Have any gone public?
Yes, some of the bigger, more successful ones have listed on stock exchanges, but many others are much smaller, more regionally constrained.
Anything else to know about them? Any risks?
Well, because they often struggle to attract deposits compared to the bigger banks with vast networks, some sources suggest they might offer quite aggressive wealth management products with unusually high interest rates to pull in funds,
So, potentially riskier investments being offered.
potentially. It's definitely an area where you'd want to be discerning and really understand what you're buying. And we should also just briefly mention there are thousands of even smaller rural financial institutions, rural commercial banks, credit co-ops often supported by local governments, but they have much lower visibility.
Okay, that paints a much clearer picture of the different layers in China's banking system.
So, yeah, wrapping things up for today's deep dive. We started with the Bank of England, saw how it was born out of necessity, how it solved the government's borrowing problem.
And how it wasn't just the bank itself, but also the political system, Parliament's guarantees, and the reformed tax system working together that fueled Britain's rise.
Exactly, a whole ecosystem.
Right.
Then we jumped to modern China, looking at that incredibly diverse banking landscape.
Right. The dominant state-owned giants, the adaptable joint stock banks finding their niches, and those locally powerful but varied city commercial banks.
Each category shaped by its own history, ownership, and playing a different role in the economy.
And understanding these structures, whether it's the historical roots of central banking in the UK or the complex tiers of China's system today, it really gives you, the listener, valuable context, doesn't it?
It absolutely does. It helps make sense of the global economic landscape, maybe even inform some of your own financial choices.
So to leave you with something to think about.
Here's a final question to ponder. How do these really fundamental differences in ownership, in history, and political context between banks in different countries actually shape how they react when faced with big global challenges, like financial crises or major shifts in the world economy?
How does that deep structure influence their response on the surface?
Exactly. Something to mull over. How did the foundation dictate the reaction? Until next time.
Thanks for joining us.